Watch what happens. The second price touches this zone. It rallies straight into it, gets rejected almost instantly, and then it doesn't just pull back, it falls. All the way down, no bounce, no hesitation, straight through several lower levels before it finally finds support. I haven't told you why that zone held yet, and I'm not going to, not for a few minutes. Because the reason it held is the whole point of this video, and once you see it, you'll start noticing it everywhere. Stick around, because by the end, I'm going to give you a settings tweak for when you're trading something a lot choppier than this, where the default setup starts throwing out too many signals. Open up TradingView, click Indicators, and search Volume Trend Order Block Engine. You're looking for the one from Big Beluga. Click it, and it loads straight onto your chart. Most order block indicators mark every single swing high and low as a zone, so you end up with a chart covered in boxes and no real way to tell which ones matter. This one only calls a zone tradable once the volume behind it actually backs it up. Start with the line running underneath price. Teal means you're in an uptrend, magenta means you're in a downtrend. It's built like a super trend, but instead of a fixed number, it measures the average size of your recent candles and builds its bands off that. So a calmer chart gets a tighter line, and a wilder one gives price more room before it flips. That shaded cloud between the line and the candles just makes the trend obvious at a glance, even with the sound off. Here's why that line doesn't just track price. In an uptrend, it can only ever move up, never back down, even on a pullback. So a shallow dip that doesn't fully break it just gets absorbed. The trend holds, and every zone still on the chart stays live. It takes an actual reversal, price genuinely crossing that line, to flip it and start fresh. That's why you won't see every little wobble wiping out your zones. Now the boxes. Every time price makes a swing in the direction of that trend, a zone gets drawn right at that swing. But look closer. Each box is actually split into two sections, a lighter one and a darker one, and each one's labeled with a percentage. That split is the volume ratio for the candles that made up that swing. So if 60% of the volume in that window came in on up candles, 60% of the box gets marked buy, and the rest gets marked sell. That's what actually separates this from a normal order block tool. A plain order block just tells you where the swing happened. This one tells you who was actually in control while it happened. And stick with me, because once you start reading that split, you'll notice it lines up with which zones actually hold and which ones just get blown straight through. That's the part most people watching this are about to trade completely differently from now on. Then you've got these small cross marks above or below a candle whenever price comes back and retests one of these zones. That's the indicator flagging the retest for you, so you're not sitting there squinting at a chart trying to spot it yourself. And once price completely breaks through a zone, the box just disappears. That's on by default, and it keeps your chart from filling up with dead zones that don't matter anymore. Now here's the part most traders would miss completely. There are two fields buried in the settings that quietly decide whether a zone ever actually becomes a signal. Open the settings, and you'll see them. Min buy percent and min sell percent, both sitting at 50 by default. Most traders would look right past these. Here's the trap though. The box appearing isn't the signal, it's just a zone. The actual signal, that little cross mark, only fires once the volume split inside that zone clears whatever percentage you've set here. So raise that number, and you're telling the indicator to only flag retests on zones where the volume was genuinely lopsided, one side clearly winning. In plain terms, you get fewer signals, but the ones you do get were backed by real conviction, not a coin flip. Lower it, and you'll get more retest signals firing, including on zones where the volume was close to even, which means more noise mixed in with the good stuff. There's a second lever worth knowing about, and it's a bit sneaky, because one setting quietly does two jobs. The volatility SMA length feeds the trend line's bands, but it also sets how tall these order block boxes are. Most traders would assume it's just a trend setting. Raise it, and you're averaging over more candles, so the zones come out bigger and slower to form. In plain terms, you get fewer chunkier zones that don't react to every small wobble in price. Lower it, and you're averaging over fewer candles, so the zones shrink and shift with whatever's happening right now. In plain terms, you get quicker, tighter zones, but on a genuinely noisy chart, they can flicker around more than you'd like. For a signal to mean something here, you need three things lining up at once. First, the trend has to already be established, so the line's already teal or already magenta, not in the middle of flipping. Second, that swing has to have printed a fresh zone, one that doesn't overlap the last one still on the chart. And third, when price comes back to retest that zone, the volume split inside it has to clear your min buy or min sell threshold. Miss any one of those three, and you don't get a cross mark no matter how good the zone looks. So what does that look like when you're watching it happen live, in both directions? Quick thing before the worked trades. Everything I just showed you only pays off if you're watching the moment one of these retests fires. And be honest, half the time that happens while you're at work, asleep, or you've just looked away for 5 minutes. That's the real reason a good read doesn't become a good trade. So more traders are taking a tested strategy like this one and letting it run automatically on their own account or a prop firm challenge. So the setup still gets taken whether they're watching or not. And you get one-on-one guidance from ex-City of London traders instead of figuring it out alone. If that's you, there's a short video on the site that shows exactly how it works. The link's in the description. Right, back to the charts. Let's start bullish. Here's the Nasdaq on the 15-minute. Price has just dropped hard. And right down here at the bottom of that move, a fresh bullish zone prints. Look at the split inside it. This one's showing heavy buy dominance, well over 80%. That's the volume telling you sellers were mostly done by the time this zone formed. Price pulls back into that zone, the retest fires because the buy percentage clears the threshold. And that's your entry, right as price re-enters from above. Stop loss goes just under the bottom of the zone itself, not further down under the whole prior swing, because if price trades through the zone that formed the signal, the idea is already invalidated. Target's set at roughly a 2-to-1, using the height of the zone itself as your unit of risk, so you're looking for a move at least twice the size of that stop distance. Now the bearish side, and this is the trade from the start of the video. Gold rallies hard into this magenta zone up here. Inside it, sell dominance is sitting around 65%, so more than half the volume through that swing came in on the way down, even though price was climbing into it. Price taps the zone, the retest signal fires because sell percentage clears the threshold, and that's your short entered right as price rejects from inside the zone. Stop loss sits just above the top of the zone, again not above the whole rally that led into it, because once price closes back above this specific zone, the setup's done. Target's the same logic, roughly 2-to-1, measured off the zone's own height. And this time, that target gets hit, and then some, all the way down through several levels below. Same rules, both directions. Trend established, fresh zone, volume backing it, retest confirms it. Quick bonus before you go. If you're trading something choppier than gold or the Nasdaq, say a smaller altcoin or a lower time frame that whips around a lot, push those min buy and min sell thresholds up, somewhere around 65 to 70%. You'll get noticeably fewer signals, but only the ones with real volume conviction behind them will make it through, which matters a lot more on a chart that's already noisy. One honest thing worth saying, this indicator needs a handful of bars to confirm a swing before it draws the zone, so you're always seeing the picture slightly after the fact, not predicting it in advance. It's telling you what already happened with real conviction behind it, not what's about to happen next. If you want to see this same idea play out on a completely different kind of tool, I recently covered an AI-powered moving average that works off a similar principle, confirming a trend once it's genuinely underway rather than guessing at it early. That one's on screen now if you want to check it out next. Stay disciplined, keep learning, and I'll see you in the next one.